as we are approaching towards that fag end of the year. Tax planning becomes our top priority. We start exploring different options, which gives maximum tax benefit, higher returns, and keep our investments sound and stable. We also look for option where we can park our funds for the bare minimum time so that we can liquidate at the shortest time. Though there are quite a few options available for tax savings, one such scheme that is my personal favorite is ELSS. ELSS has dual benefits and easy to understand. Hello friends, welcome to the channel of Wealth FinMart, and today presentation is of Equity Linked Savings Scheme. What is ELSS? Equity Linked Savings Scheme is an open-ended equity scheme with statutory lock-in of 3 years with tax benefits under Section 80C of the Income Tax Act 1961. The scheme predominantly invests in equity and equity-related instruments and suitable for wealth creation. Let's look at the characteristics of ELSS. 1. An ELSS allows an individual or HUF a deduction from total income of up to 1.5 lakhs rupees under Section 80C of the Income Tax Act 1961 and save taxes up to rupees 46,800 annually. 2. It has easy access to equity markets. 3. The fund makes diversified stock investments across a range of market capitalizations, themes, and industries in large, mid and small caps. ELSS is beneficial to whom? ELSS is most suitable to salary class people. Under Section 80C they can take the benefits, and if they follow SIP, it fits the bill perfectly. Since they intend to stay longer time in salary, the risk also gets spread and they can easily get returns of 10 to 11% per annum. Patience investors can look forward for wealth creation. It is also prudent to save your taxes wisely. Swot Analysis. Strengths. The biggest strength is it has the lowest lock-in period compared to other tax savings instruments. ELSS has only 3 years lock-in and you can churn your capital with lowest cycle. Secondly, grow your investment with the power of equity and save on tax. Weakness. ELSS has element of risk since the amount is invested mainly in equity. Equity is volatile and hence that risk element will always remain. Many young dynamic investors invest mainly because it has the shortest lock-in period. This is not correct. Short-term investment horizon with ELSS funds should be avoided due to their inherent volatility. Secondly, there are no guaranteed returns in ELSS scheme. Rapid fire round. First question. Can lump sum be invested or it should be in form of SIP? Both options are available to invest depending on individual preference and availability of funds with investors. Second question. How can I redeem in ELSS? In case of lump sum investment, the amount can be redeemed the moment 3 years tenure is complete and all units are free for redeemable. But in case of SIPs it is little tricky and needs to be understood. In SIPs each installment paid has to complete 3 years before redemption. For instance, a SIP installment paid on 1st January 2020 can be redeemed only after 1st January 2023. And a SIP installment paid on 1st February 2020 can be redeemed only after 1st February 2023 and so on. Question 3. Can I do premature withdrawal if I need funds? Premature exit is not permitted under this scheme. Question 4. Can I withdraw fully or partial as allowed in case of PPF? Once the mandatory period is over, full withdrawal is allowed, though partial withdrawal is by your own choice. Question 5. What is the interest rate in ELSS? No fixed interest rate is payable under this scheme. Question 6. Are the gains achieved through ELSS taxable? Yes, the returns are taxable. You obtain long-term capital gains, or LTCG, when you redeem the units. Up to 1 lakh rupees in one financial year are tax-free. Any LTCG above this threshold is subject to a 10% tax on gains. Question 7. Should I go for dividend option or growth option? Always advisable to go for growth fund. The benefit of compounding is available. Dividend is taxable and no longer lucrative. Let's compare ELSS with other tax benefit options under Section 80C of the Income Tax Act. If you look at the chart, you will find that ELSS is a high-risk, high-return with shortest lock-in period. Other options you will definitely find with lower risk and lower returns compared to ELSS, and their tenure are also bigger. How to choose a right ELSS scheme? With so many AMCs floating around in the market and so many ELSS schemes available, it becomes sometimes really difficult in selecting the correct ELSS fund. Well, in such cases you can take the help of a financial advisor who can suggest or help you in choosing the right fund, or alternatively, you can visit the website of Morningstar or Value Research or Money Control, which help you to advise which funds are performing well. But again, it is based on historical data of last 5 years or 3 years, which does not assure you that past performance may be repeated in future also. However, if you do your own in-depth studies, you can consider the parameters like track record of last 5 years, or Sharpe ratio or expense ratio, or how much the alpha has been created by the fund manager in selection of the fund. For this you need to have little expertise in scheme selection. I personally feel most of the ELSS invest mainly in blue chip companies, so opting which one to choose should not be difficult, since all schemes run by professional managers. Some of the recommended tax saver funds. Returns since inception. Parag Parikh Tax Saver Fund 22.52% per annum. Canara Robeco Tax Saver Fund 19.15% per annum. Kotak Tax Saver Fund 12.71% per annum. Mirae Asset Tax Saver Fund 18.05% per annum. ICICI Long Term Tax Savings Fund 19.29% per annum. Quant Tax Fund 15.27% per annum. HDFC Tax Saver 23.30% per annum. Very recently, even ELSS index funds have been launched. IIFL ELSS Nifty 50 Tax Saver Index Fund is first of its kind, with 80C tax benefit of Income Tax Act with lower cost of expenses. It predominantly invests in Nifty 50 index in top 50 stocks with market capitalization. The investment style consists of investing in the same proportion as in the index to achieve returns equivalent to total returns index of Nifty 50 index. Conclusion 1. ELSS is no-brainer, a win-win situation. Though limitations are there, but it is definitely a worthy proposition. 2. If you invest through SIPs, you can take rupee cost advantage also. 3. ELSS funds have the potential to offer returns that are double that of a conventional savings plan. 4. ELSS funds can offer payouts that are higher than a basic savings plan. Over a period of 10 years, you can get substantially higher returns. than other tax savings schemes. 5. Since managed by professional fund managers, the returns can go as high as 12 to 14% and even more if held above 8 to 10 years. 6. Lot of investors are inclined towards ELSS due to dual benefits: tax savings and wealth creation. We now come to the end of the presentation. Mutual funds investments are subject to market risk. Read all scheme-related documents carefully. Investors should consult their financial advisor before taking any decision. This is Wealth Finmart signing off. Goodbye and thank you.